Welcome to the Deep Dive. Today we are jumping into a really interesting one. We're looking at the Q3 2025 earnings for the Brazilian fintech giant StoneCo.
Yeah, and we're starting right with the central puzzle of this quarter. Because what management presented was, a story of really steady execution. They even raised their full-year guidance.
And yet
the market reacted very negatively. The stock got punished pretty hard after hours, and it just continued into the next day. So our job today is to really unpack that disconnect.
it's a fascinating tension. And for you to really get it, you need the context. I mean, this is a huge fintech in Brazil, and they're operating in an environment where the Selic rate, their benchmark interest rate, is at a staggering 15%.
Right, and at the same time, they're in the middle of this massive strategic pivot, selling off big parts of their business to focus, laser focus on just one segment.
The MSMB segment, micro, small, and medium businesses.
Exactly. So it's a high-stakes game. Let's start with the numbers that hit the wire after the market closed on November 6th.
Okay, so the bottom line, earnings per share, did they deliver?
They delivered in a big way. Adjusted basic EPS came in at $2.57 per share. That's about 48 US cents.
And what was the street looking for?
Consensus was somewhere in the 41 to 43 cent range. So this was a significant beat, a mid-teens percentage beat, and a 31% increase from last year.
A 31% jump year over year, that's a strong number. What about the top line then? Revenue?
Revenue was almost boringly in line. Total revenue and income was $3,566.8 million, which is about $667 million. It missed consensus by, I think, 0.1%, so basically a rounding error.
So to recap, a major beat on profit, revenue right on the money. You'd think that would be a recipe for a rally.
You would think. But the market skepticism was immediate. The very next day, trading volume spiked to 2.7 times the average.
And that wasn't people buying in.
No, this was clearly a big rotation out of the stock, a sharp sell-off. So the big question is why? Why would the market see a clean EPS beat and just dump the stock?
To understand that, we have to go deeper into the financials. Because that 31% EPS growth number is a little more complicated than it looks.
It is. A very large portion of that was not just pure operational growth. It was heavily amplified by the company's focus on capital discipline.
Okay, let's break that down. First, the core profitability. What did that look like?
It was solid. Consolidated adjusted net income grew 17.6% year over year. Adjusted gross profit came in at our $1,604.9 million, giving them a really healthy gross margin of 45%.
And what about efficiency, return on equity?
That's a key metric here. For their core financial services segment, the ROE climbed up to 33% this quarter.
33%, that's a very strong number. It shows they're using their capital well.
It is. But that still doesn't explain how you get from 17.6% net income growth all the way up to 31% EPS growth.
Which brings us to the share count.
That's the real story. This is a story about capital allocation and aggressive buybacks.
So walk us through the scale of this buyback program.
It's massive. Over the last 12 months, StoneCo has bought back our $2.3 billion of its own stock.
Wow.
Yeah, that single action reduced their share count by 37.3 million shares. You're talking about something like a 10% shareholder yield just from buybacks.
And they kept that pace up in Q3.
They did. They repurchased another $465 million worth in this quarter alone.
So this is deliberate financial engineering. They're using their balance sheet to directly boost earnings per share when organic growth is maybe a bit tougher.
Precisely. And they have the balance sheet to do it. They ended the quarter with an adjusted net cash position of our $3.52 billion.
And they're still generating cash on top of that.
That's the key. They pointed out that if you exclude those Q3 buybacks, their net cash position would have actually gone up.
Yeah.
So the underlying business is throwing off a lot of cash.
Okay, so strong capital discipline. Let's shift gears to the operational engine, the actual MSMB business. Is the strategy of bundling payments, banking, and credit actually working?
The client growth numbers say yes. Total payments active clients are up to 4.72 million. That's a jump of 17.6% year over year.
And within that, how many are using the banking products?
That's growing even faster. MSMB banking clients grew almost 22%, now at 3.46 million. So yes, the ecosystem approach, the cross-sell, it seems to be working.
But this is where the fear starts to show up, right? The total payment volume, or TPV, the amount of money actually flowing through their system.
Right. TPV saw a slight deceleration. Total TPV grew 8.8%, and the core MSMB TPV was up 10.9%.
And the market sees deceleration and immediately thinks price war.
That was the fear. But management was very clear on the call. They pushed back on that idea. They said this wasn't about competitors slashing prices.
So what was it then?
They pointed to the macro, a more challenging macro environment. They said same-store sales of their small business clients were just softer. People are spending a bit less.
And that's a really important distinction. A tough macro environment is temporary. A race to the bottom price war is structural.
Exactly. And speaking of structural, we have to talk about Pix, Brazil's instant payment system.
It's just a force of nature in that market.
A monumental force. Pix QR volumes grew an explosive 49.1% year over year, just dwarfing card volume growth.
So you can't fight it.
You can't. And Stone's strategy admits that. They're not trying to win a TPV share battle against a zero-margin product like Pix. They're doing something smarter.
They're using their terminal, their presence with the merchant as the gateway.
Precisely. The terminal is the entry point. It collects the data. It establishes the relationship. And then they use that to cross-sell the high-margin stuff, the banking and the credit.
And you can see that working in their funding strategy.
Absolutely. This is one of the most interesting data points. Retail deposits grew over 32% year over year. They're at $9.0 billion now.
So they're using their own clients' deposits to fund their operations.
Which is so critical in a 15% rate environment. It dramatically lowers their average cost of funds. It's their most important lever right now.
And that cheaper funding allows them to be more aggressive on the lending side.
Correct. The total credit portfolio nearly tripled. It's up to $2.3 billion, and it grew 27% just from Q2. These are mostly short-term working capital loans to merchants.
Okay, but a 27% sequential jump in a credit book with interest rates at 15%. That sets off all kinds of alarm bells for investors about asset quality.
It does. And management knew they had to address it. They pointed out that their cost of risk actually improved. It fell to 16.8% from over 20% in Q2.
So losses are under control for now.
For now. They said it's within their expected range. They acknowledged that non-performing loans ticked up a little to just over 5%, but they call that natural portfolio maturation.
And all of this focus on the core fintech is made possible by the divestitures, right? The strategic cleanup.
Absolutely. Getting rid of the non-core software assets, like selling links to TOTVS for around our $3.4 billion is huge. That business was, 9% of revenue, but it lets them focus 100% of their time and capital on the MSMB fintech stack.
Which brings us back to the guidance. They clearly have confidence. They reaffirmed their 2025 EPS guidance to be above $9.06.
Right, which implies over 32% year-over-year growth. And they also said their big internal reorganization, moving away from business unit silos, is almost done. That should help efficiency.
But as we keep coming back to, the elephant in the room for StoneCo is always the Brazilian macro, that 15% Selic rate.
It's the ultimate valuation lever. The stock is just incredibly sensitive to it. Yeah. And management actually quantified the impact, which you don't always see.
How big is the lever?
They were very specific. They said for every 100 basis point drop in the Selic rate, so 1 percentage point, it could add roughly $250 million to their annual pre-tax profit.
That is massive.
It's enormous. Now, they did add the caveat that over time, some of that benefit gets competed away. But the immediate tailwind would be huge.
So apart from just waiting for rate cuts, where does management see growth coming from in 2026?
Two main places. First, just the maturation of that $2.3 billion credit portfolio. It's going to start becoming a really material contributor to the P&L. Yeah. And second, just continued cost cutting, OPEX management, finding savings in logistics and tech.
Okay, so let's try to tie this all together one last time. Why the 10.8% sell-off? They beat EPS, raised guidance, they're buying back stock like crazy. What gives?
It's a convergence of three big fears. And it was amplified because the stock had already run up so much. It was up over 40% in the 3 months before the report.
So it was a crowded trade.
Very crowded.
Yeah.
So the first fear is just skepticism. Can they really sustain these margins with Pix eating the world? The market fears pricing pressure is worse than they let on.
Okay, fear number 2.
Credit risk, plain and simple. Ramping a credit book that fast at a 15% rate is risky, period. Even if the numbers look okay today, investors are worried about what's coming next year.
And the third fear was the positioning you mentioned.
Exactly. The stock was a crowded theater. The TPV deceleration was like a small whiff of smoke, and everyone just ran for the exits at the same time, regardless of the strong financials. The macro fear won out.
Which sets us up perfectly for our final segment. And as a reminder, this is purely for educational purposes, a thought experiment. We are now pitching an outrageous but plausible trade idea to our hypothetical investment committee.
This is not financial advice. My pitch today is simple. Go aggressively long StoneCo. The ticker is STNE. And the entire thesis is what we're calling the rate cut acceleration thesis.
Okay. The stock sold off on macro fears, so you're betting against that fear.
I'm betting the market have the timing and the pace of the easing cycle completely wrong.
That's a bold bet. What's the outrageous part?
The outrageous bet is that conditions in Brazil will force the central bank to start an aggressive, front-loaded easing cycle starting in early 2026. Not a slow trickle. I'm talking forced, rapid cuts.
So something like,
Let's say 400 basis points in the first half of 2026. If that happens, you get that instant R200 or $250 million pre-tax benefit per 100 BPBs drop. It becomes this massive, immediate financial tailwind.
but betting on aggressive rate cuts is what's burned so many people before. What makes you think the central bank will be forced to move that fast?
Because the market right now is completely ignoring the magnitude of that leverage. It's pricing StoneCo as if this 15% rate will last forever. You combine that massive rate cut tailwind with the 10% buyback yield and the raised guidance of over $9.06 in EPS. The market is mispricing the duration of profitability here.
And what gives the company the ability to wait for your macro bet to play out?
The balance sheet. They're sitting on over $3.5 billion in proceeds from the divestitures. They're flush with cash. They can weather any temporary margin pressure while they ramp that high-yield credit book. The financial boost from those rate cuts, when they come, will justify a price far, far above the $16.83 it closed at recently.
That is a deep dive completed. So the core takeaway for you is that StoneCo delivered strong EPS growth, really amplified by capital returns, while making a huge pivot to its core business.
But they face a massive test. Can they sustain their margins and growth in this super competitive landscape while they wait for the macro environment, specifically that Selic rate, to finally turn in their favor?
And we will leave you with a final provocative thought on that.
Given this management team's proven commitment to disciplined capital returns and their focused strategy, should you, as an investor, prioritize that long-term, highly sensitive earnings trajectory that will benefit from rate cuts? Or should you fear the immediate competitive and credit risks that are staring them in the face right now?
Plenty to think about there. Thank you for joining us on this deep dive into StoneCo. We encourage you to keep exploring, and we'll catch you next time.